Warren Buffett calls this book, The Intelligent Investor, by far the best book on investing ever written. I mean, that's some seriously high praise, right? So what we're going to do is unpack why. Why are these lessons, written all the way back in 1949, maybe more important for all of us today than they have ever been?
So let's start with a story. This quote here is from Sir Isaac Newton. Yeah, that Sir Isaac Newton, the guy who figured out gravity, literally one of the smartest human beings to ever live. You'd think a guy like that would absolutely crush it in the stock market, right? Well, he got wiped out. See, back in the 1720s, he invested in the hot stock of the day, the South Sea Company, and he actually doubled his money. And being a genius, he sensed things were getting a little bubbly, so he did the smart thing. He cashed out.
But he then had to watch his friends keep getting richer. And that FOMO, that fear of missing out, it just ate him alive. He jumped back in at the very top of the market and lost a fortune, 20,000 pounds. In today's money, that's over $3 million, just gone. He was so devastated, he actually forbade anyone from ever saying the word South Sea in his presence again. The lesson here is pretty clear. If a mind like Newton's can get crushed, your raw intelligence is not going to save you either.
Newton's story really gets to the core problem that Benjamin Graham is trying to solve. He says, the greatest danger to your portfolio isn't a bad stock or a market crash. Nope, it's the person looking back at you in the mirror. And to defend against our own worst instincts, Graham insists we start by making one absolutely crucial distinction.
He draws a hard line between investing and speculating. For Graham, an investment is a business operation. You do your homework, you protect your initial capital, and you aim for a satisfying return, not a spectacular one. Anything else? That's not investing. That's speculation. It's a gamble, and intelligent investors do not gamble. But okay, how do you stay disciplined when the market is going completely crazy around you?
Well, this is where Graham gives us one of the most brilliant mental tools in all of finance. He asks you to imagine the entire stock market as a person, your very own business partner, a guy he calls Mr. Market. So just imagine you own a piece of a business, and you have this partner, Mr. Market. Every single day, he shows up and he offers to either buy your shares from you or sell you his shares at a specific price. The only problem? He's a complete manic depressive.
Some days, Mr. Market is totally euphoric. He's convinced the future is unbelievably bright, and he'll offer you absurdly high prices for your shares. Then on other days, he's gripped by absolute despair. He's sure the world is ending, and he'll offer to sell you his shares for just pennies on the dollar. But here's the most important part. He doesn't care if you say no. He'll just be back tomorrow with a totally different offer.
And that is the entire key. You are never forced to trade with Mr. Market. You can just ignore him. But the intelligent investor, they use his moods. When he's panicked and offering a crazy bargain, you buy. When he's euphoric and offering a silly price, you sell. You have to remember, he is there to serve you, not to guide you.
So when you buy from Mr. Market only when he's depressed, you're using Graham's single most important principle. This is the central concept of the entire book. It's your ultimate defense against all the uncertainty of the future. In his own words, if you had to distill the secret of sound investment into just 3 words, this would be it: margin of safety. So what does that actually mean? Let's break it down. First, through really careful analysis, you figure out the intrinsic value of a business. This means you ignore the day-to-day stock price and figure out what the company is actually worth, based on its assets, its earnings, and its future prospects. So, let's say your analysis shows it's worth exactly $1 per share. Now, you don't go and pay $1 for it. An intelligent investor insists on buying that $1 business at a significant discount. Let's say you're only willing to buy when Mr. Market offers it to you for just 60 cents.
That 40-cent gap, the difference between the value and the price you paid, that is your margin of safety. It's your cushion, it's your protection in case your analysis was a little off, or if the company hits a rough patch, or if you just run into some plain old bad luck. The future is always uncertain, but a large margin of safety means you don't have to predict it perfectly to succeed.
Okay, so you've learned to separate investing from speculating. You know how to treat Mr. Market as your servant, not your master, and you always insist on a margin of safety. You're all set, right? Not quite. Graham warns that after all that, there's one final opponent you absolutely have to conquer.
And that opponent is you. Psychologists have proven that the financial pain of losing money is more than twice as intense as the pleasure you get from an equivalent gain. That's why we panic when markets fall. Our brains are hardwired to overreact to loss, which leads us to make the disastrous decision of selling low, right when Mr. Market is most depressed.
This all brings us to Graham's final lesson. Focus only on what you can actually control. You can't control the stock market, you can't control the economy, you can't even guarantee your own forecasts will be right. But you have absolute 100% control over your brokerage costs, your diversification, your taxes, and most importantly of all, your own behavior.
In the end, intelligent investing isn't about outsmarting other people. It's about controlling yourself. It's not about finding the next hot stock. It's about building a framework to protect you from your own worst instincts. So Graham's final question is really for you. Can you master your emotions and become your own best financial ally?